Sustainability. That's the word of the day. In other words, can the moves we've seen in everything from AI stocks to gold to Bitcoin sustain themselves? Or are markets increasingly getting out over their skis at the start of the fourth quarter? Of course, investors are contending with many other issues here too, from the government shutdown to an economy that's splintering in housing, in the consumer space, and in the labor markets. To help unpack what it all means, I'm pleased to have another all-new guest on the Money Show MoneyMasters Podcast. She is Marta Norton, Chief Investment Strategist at Empower Investments. Marta, welcome to the program. Marta, thanks so much for joining me here. First-time guest on the Money Masters Podcast. I look at this market, I try and come up with sort of an illustration or analogy, and all I can think of is the Energizer Bunny. I mean, it just keeps going and going. So what could derail this market, if anything? Or do you think this type of move is justified by the fundamentals and everything you're looking at?
I would suggest that the move that we've seen thus far, at least kind of the directionality, seems justified. I mean, when you take a look at where earnings expectations fell to as Liberation Day kind of unfolded, and then how companies have actually performed vis-a-vis those expectations, I think that there's plenty of strong rationale for an upward movement. I think the concern that I would have, and this is something that a lot of folks are articulating, is just the momentum behind it and the degree to which so much of it hinges on AI and the AI trade and the kind of incestuous deals that are coming out of that space. So I think when I'm taking a look at where we go from here, I think there is some downside risk. We have very, very high valuations, so there's kind of low immunity to the stock market. Any outside risk factor could throw it off. And I also think that the health of the economy, the health of the rally is more concentrated than ideally we would like.
Got it. And I definitely want to unpack a couple of those points. But first, I just wanted to talk about, I mean, you brought up Liberation Day. To me, it's the resilience of this market. We obviously a very sharp pullback, but one that we recovered from very quickly. We had geopolitical things sort of floating around in the background. Those don't seem to be derailing the market. What do you think that just the sustainability or the bounce back appeal that we've seen?
Well, at first, the bounce back really seemed to be rooted in the fact that the trade embargo against China was taken off the table. Remember, we had those reciprocal tariffs. They go into place, and then immediately there's this kind of standoff between China and the U.S. that emerges. And then that comes off the table, and the market has this strong recovery. But then I think it gained additional ground when we started to see that the tariff effect was not something that would immediately be felt by companies or by consumers. That doesn't mean, and I think here's the mistake that we can fall into, that because we haven't seen an immediate effect, it is therefore inconsequential. I think it's still something that's consequential. And one of the things I return to is just the massive expansion we saw in corporate profitability in the wake of globalization. I don't think we'll have that same, force behind profitability if we start to shift toward a deglobalization. And so the idea there being that this is kind of a long drag, not an immediate, running into a wall type of situation. So to me, it seems like in the immediate future, in the short run, this isn't necessarily a seismic event. In the long run, it's something that we have to contend with.
Got it. One of the other things I think I have to ask about as we're recording this is the shutdown. It's still out there. We're into
Yeah.
kind of week 2 almost. What are your thoughts on the economic and market impact? Because I know you did one of your updates on LinkedIn the other day, and you said historically government shutdowns haven't lasted long. As the economic costs climb, so does political pressure, and you get a self-correcting mechanism.
Yeah. I do think that there is some self-correction there. Now, there's the outside risk factors that are unique to this particular shutdown. Of course, we have very polarized parties in the U.S. There's not a lot of desire to compromise on either front. We also have, I guess, more brinksmanship. So the Trump administration less likely to just want to come to the table, but also want to introduce some downside risk factors if Democrats don't negotiate. So there are some kind of unique elements of this particular shutdown. But I think generally speaking, it's one of those almost kind of bond market definitions. It's not an ability, it's a willingness. And so we have to have that willingness come into play. And I do think as costs escalate, you're going to see parties negotiate. The centrists kind of come out of the shadows. One of the things that I think is especially interesting is the lack of official government data at a moment where we're very inflection pointy. And so I think there's just risk that we extrapolate our own views without data to kind of offset those views. I don't think that's necessarily something that is going to change the course of the Fed, but it's something that we have to kind of be watching as we're trying to interpret private market data, or we're trying to ascertain what would government data be if we had it. I think it just creates additional uncertainty at a moment where we're really looking for clarity.
Got it. And let's bring that. Let's pivot to the Fed here. I mean, we've got a couple more meetings in 25, and obviously a few after that in the first quarter of 26. What are your thoughts on how things unfold?
Well, I think in 2025, at least, there's decent alignment between the market and the Fed. So, in expectation for two additional cuts, I think when we talk about a lack of data, maybe additional uncertainty, I think that maybe tilts the margin in favor of an additional cut, just in favor of that kind of risk management approach that Powell has talked about. I think the bigger disconnect between the market and the Fed occurs over the course of 2026. One thing that's been super fascinating to watch repeatedly throughout the past several years has been how much the market has gotten ahead of the Federal Reserve. The market gets so excited about cuts, then has to pull back because the Fed's not quite there yet. And I think there's a little bit of that when we take a look at what the Federal Reserve estimates as that long-term Fed funds rate. It's around 3%, and the market's saying that we'll get there by this time next year. And that seems to be either the result of inflation that perfectly and quickly deflates, or the result of a labor market that's weaker than the equity market actually thinks that it is. So it strikes me that that 3% expectation over the course of the year is either too optimistic or not rooted in the right argument, given how strong the equity market is.
Got it. And when it comes to the underlying economy, you had a piece, your Q4 outlook, calling it the market sort of, or excuse me, the economy sort of splintering.
Yeah.
Whether housing, consumer spending, and so on. Can you elaborate on what that point means?
Yeah. So when we take a look at the headline numbers, whether we're looking at the labor market or we're looking at GDP, or any other kind of metric on how the economy is doing, those numbers are reasonable. Earnings are strong. There's a lot of reasons to think that we're in a healthy place. But when you think about what the individual is experiencing, that's really I use the word splintering because it really varies based on a number of different criteria. Are you low income or high income? Do you own a house or do you not own a house? Do you have a big investment portfolio or do you not have a big investment portfolio? Are you early in your career, entry level, in which case the unemployment rate is a bit higher? Or are you later in your career and more established? If you cut along these different dimensions, you might have a very different view on how healthy the economy is. And the interesting thing about this, and I'm sure this is always true to a certain degree, right? Each person's experience is a little bit different, but it seems more extreme in the current environment. And I think it creates kind of a policy dilemma because it's hard to manage to different splintered groups, right? And I think it also has maybe more political ramifications because it depends on how different people interpret the economy based on how they vote. And so I think it's something that we're really wrestling with as we start to take a look at 2026 and get a sense for what are the ramifications of it.
Got it. If we look at markets here, I mean, you brought it up earlier, the sort of AI trade, the dominance of being in the market in general, and now there's questions being raised about the circular nature of some of these deals and so on. What are the risks or opportunities there? What are your thoughts on that trend?
It's so tricky. And I think this is something that a lot of us are wrestling with. The AI train seems real, right? This seems to be a truly innovative technology that can transform the economy, whether you're thinking about something like healthcare and how research and development is done, or you're thinking about, something as banal as call centers and how you can automate that. I mean, there's so many different applications that could really improve earnings and improve revenue. But the question is, how much of this is priced in? And what kind of timing are we looking at? Are we expecting a straight line higher, which is kind of how it has felt since April 8th, just a straight line higher where AI adoption is just perfectly implemented over time? Or are we looking at something that's more fits and starts? And I think from a realistic point of view, fits and starts makes more sense. And so I think we can and should expect more DeepSeek moments as AI unfolds. And DeepSeek was interesting because that focused on kind of the supply question. But I think a more troubling question for AI would be the demand side. Is this actually as profound as we think it is. And so I think as we have those moments of doubt, to me, those are the better investment moments than kind of chasing the euphoria that seems to be dominant in the market today.
Got it. I guess the other big trend that I'm seeing, is the thing we're dubbing it the debasement trade, whatever term you want to call it. I mean, we've got gold the day we're recording, futures testing $4,000, Bitcoin stopped 125,000 over the weekend again. You know, that's a sustainable move. Or what are your thoughts on that trend that we're seeing?
Well, I mean, it depends on how we're measuring sustainability. Do I think it's going to necessarily collapse in the immediate future? No, but I think one of the things we have to determine as each of us on our own is how we make determinations on when something is a buy and when something to sell. And the struggle that I have with something like gold or Bitcoin is determining what that fair value is. Because for a lot of investments, what you want to do is either buy something at or below its fair value and then see that appreciation. But with gold, with Bitcoin, there aren't really cash flows that you can identify that say, this is what this investment is worth. This is how it generates wealth. And so I think what we ultimately end up doing is chasing the technicals. Other people are buying, so we start to buy. And that's fine. And it can last for a really long time. That doesn't mean it shouldn't be in your portfolio, but I think you should recognize that there might not be as strong a foundation to that investment as you think. And so when it sells off, how do you respond? And so that's one of the things that I think about with those investments. I don't think there's anything wrong with holding them in a portfolio, but I do think people want to understand why they're moving higher and what they would do, what their recourse is going to be if they start to sell off.
Got it. Within the equity markets, I mean, we've talked about tech. Are there other trends you're kind of watching that you find interesting and, opportunistic? I mean, we've seen, for example, another big banking merger. I'm wondering maybe wheels are on financials.
Well, I mean, financials have been a pretty good place to be really in the wake of the regional banking crisis that we had several years ago. You had this massive valuation opportunity open up. It was a great time to invest. In fact, I looked at research that shows that in the wake of a crisis, that's the great time to move into financials. The ones that stick around tend to do quite well and outpace the S&P 500. And I think there are some kind of overarching, I guess, catalysts in the space, whether we're looking at deregulation, for example, within financials, or more broadly, I think deregulation is a big theme. I think the CapEx cycle, mostly related to AI, but also broadly, when you think of the One Big Beautiful Bill Act, 100% expensing, I think that's another big theme to rely on. But what I keep coming back to, and I know I beat a tired drum here, but I keep coming back to what's in the price. And I think a lot of this good news is priced in not just for tech, but it's priced in industrial, it's priced in consumer staples, it's priced in financials. And so there are some real themes out there. I just don't know what's not in the price at this point.
Yeah. Well, one of the reasons we're speaking is obviously we're honored to have you speaking at our Money Show Master Symposium in Sarasota, which is at the beginning of December. It's still some time between now and then, but what are your thoughts on maybe some messages, a few bullet points you might share with attendees there, and
Yeah.
your early thoughts about how you think we're going to be when we roll into 26?
I'm super excited to attend. It's great timing. It's December, and Chicago in December is not the best. So I'll be thrilled to be in Florida. And we're just finishing up our 2026 outlook at that point. So I'll be sharing kind of what is our outlook for the economy, for stocks, for bonds. And we're focusing in on three key research areas. I think the housing market is super fascinating at this point. The wealth that's been created in the housing market, how we can have affordability more broadly. That's one topic that we're going to dig into. I also think the sovereign debt question is really important, both in the US and outside the US, and thinking through kind of what does that mean for the yield curve, particularly at the longer end, and what our expectations should be. Of course, we can't avoid AI. So we're going to continue to explore that topic, and especially around, questions of how is AI demand manifesting itself and what can we expect going forward.
Well, Marta, listen, I want to thank you so much for joining me here. Appreciate you taking some time out to share your thoughts. Viewers, if you're watching this, be sure to join us at the Money Show Master Symposium. It's in Sarasota. It's an all-new venue, the Ritz-Carlton downtown. That's December 1st to 3rd, and you can find a link in the description below. Gives you complete details, lets you know what you need to do if you're interested in joining us. Again, Marta, looking forward to seeing you there, and great talking to you today.
Yes, my pleasure. Thank you.